All right. Good morning, everybody. We made it. So we got a lot going on today, really, and it lasts all day. There's something happening in the morning, in the afternoon. It's going to be one of those days. It's likely that we're just going to keep getting headlines. It is possible that we stick to one narrative early enough in the day and then just write it out. Uh, that would be the better way to go for sure. It's unlikely though. If you've been looking through the CME FedWatch curve, they're gently pricing in the possibility of a rate cut in June and July. So you can see the current went down, say, about a point, and the possibility of a cut, 125 basis point rate cut, has increased slightly more than a point from 41 to 42. This is July. Back it off one and look at June. Kind of the same thing from 49 to 52 basically. So June's getting a little more than July, but these are very minor moves, so can't lean too heavy in that yet. Um, if you're new to using this tool, it's easy to get caught up on these very slight changes. The the time will come eventually. One of these days you're going to come in and take a look, and there will be a radical shift to the numbers. It'll be 25, 35 percentage points. And that should really get your attention, right? That is a fundamental shift in the market's bias and expectations. What we're looking at here, these are just minor waves. So, yeah, we're seeing a movement. It's very minuscule at this point, but keep your eye on it. See if it really starts to pick up steam, and we'll check it again next week. It's not something you have to sit and stare at all day long, anyways, right? It's just something you poke around in once in a while. If you haven't seen this page before, it's free. It doesn't cost you anything. Just go to Google and type in FedWatch or CME FedWatch. You'll get this page. There are others out there, and you could use the poly market. You know, they tend to chart it more as like a line graph. Looks a little easier to read for some people. This is what I've been using for a long time, so I'm kind of used to it. But I get it. You know, you might want something that looks a little prettier. The main thing is to spot or recognize when the market is beginning to price in or unwind a rate cut. That's the long and the short of it. So you don't need to sit and stare at it all day. Just check on it once in a while. So we are green on the screen around the world. Japan up the most at 2%. Small caps right behind it, 1.25. Then everything else less than. So Nasdaq around 0.5%, the S&P, and then the Dow. So we did have this period for a while where small caps would outperform in the overnight, and then we'd get into the regular session and they would fall behind and the Nasdaq would catch up and then the Nasdaq would outperform. We want to continue to watch that this morning and see if we do get that stall out or unwind in small caps and or see an outperformance in the Nasdaq, because it's not normal for small caps to lead the way throughout the entire trading day. In the overnight, yeah, that happens quite frequently, but it shouldn't stick. So we're going to get some sentiment data this morning. It's just that warm, fuzzy feeling. And this afternoon, we're going to get some consumer data. So all day today, it's just a lot of consumer data, right? But these aren't the kind of headlines that will shake this market. So it's good to get the data, But these ain't the droids we're looking for. Nerd. The president is going to be signing executive orders this afternoon, which is one of the risks that we need to watch for this afternoon. I think that that's got a lot more threat impact than the consumer sentiment data that we're going to get this afternoon. Everybody's jumping up and down about Bitcoin making a little bit of a move to the upside, but just like with silver and gold, they when you get a market that was up a lot and then it falls radically, getting a bump back up after the fall is very likely just a rally into resistance before we roll over and fall farther. Still, after the moves that we've seen in Bitcoin, I wouldn't be surprised if we get a run in Bitcoin all weekend. It's one of those markets that you can trade over the weekend, and it's possible that we get a continuation on that. It's something to think about if you do trade on the weekends. Speaking of silver, when we look at it on the bigger time frames, you can see that we broke last week's low and we're still outside of that to the downside, and we're near the lower edge of the week for this week. Bring it in on the daily a little bit. We're inside day at the moment, but the beat down continues. We haven't set a higher high yet. All we've done is set a low and then a lower high and then a lower low. We're looking for a full set to call a trend. A full set is 2 lower highs and 2 lower lows. Then we would have a downtrend. If we start to turn it all around and go back up, we would need 2 higher highs and 2 higher lows to call it a trend for the move back, but we don't have that. CTA positioning is just crossing the 0 line here. This news came out yesterday afternoon. This Anthropic headline, they upgraded the Claude Opus to 4.6, which improves on its predecessor's coding skills. This one plans more carefully, sustains tasks for longer, and can operate more reliably in larger code bases. The interesting thing is that it has better code to review and debug and catch its own mistakes. That's interesting. So that headline yesterday was one of the things that caused some violence in the broader market. All right, so here's the risk probability for today with the White House. You can see it's above 50%. So we're in high risk based on the current schedule. The executive orders are supposed to be signed at 3 o'clock. All presidents have issues when it comes to time. This could end up being a little earlier, a little later. More often than not, if it's not on time, it's generally later. So, it doesn't have to happen right at 3 o'clock, just kind of keep that in mind. All right, overnight volumes hit 154,000. That's significantly higher than the average. The average generally runs 50 to 60,000, so we're more than 100 over in that regard. But it wasn't like we had some big sell-off, right? We've been riding back inside of yesterday's range after getting outside early. Since Europe's open, really, we got that crossover back above VWAP and just been maintaining that push. I've argued for most of the week to keep our perspective in place, right? When I zoom out here, it's really obvious this move in price, right? If we were to snap a Linreg line, we've had price working its way back and forth. But when we put it out on a daily, we've had this big, broader range, and we're still in it, right? Just kind of zoom out here. We've got this range, and then we've got this bigger range. It goes all the way back to October. So even if we do get underneath 6750, we've still got 6600 and the 200 period daily moving average. And we've got history down there where we've gone down and we've put in some work. We've got structure and levels down there. And if we're going to get a wash, that's likely where we find out what's left, right? If there's any structure left at all, we're going to catch it at that level. So sure, we could overshoot like we did here. We didn't stop on a dime at 6,600. We ended up an extra 20 points lower. But still, with all the work that we've put in, plus the 200 there, if we did get a significant breakdown below 6750, it's very likely that we would turn back on or around that 200 like we have in previous years when we've dropped down into that 200. All right, you can see the bounce from this close. The next day we opened, dropped down into that 2 and bounced up. Even the next day we bounced into the 2 and came back up, closed off of it. So when we get there, we're going to negotiate that 200 for a little bit. Even if we don't, if we get a really big bar that cuts us completely under the 2, I would still anticipate within the next day or two getting some sort of reflexive move back up through it. And I mention all this so that people don't go in and just puke out their positions off the lows just to find out the next day if they'd have held, they could have exited it at a better price. Markets, these are the indexes, right? Indexes are mean reverting. So that might not be true, with everything else. Like equities, they can keep falling and go to zero. Look at Yahoo stock, right? Oh, yeah, you can't because it went to zero and blew itself up. That's kind of the point. These are indexes. So we're still in a range. No matter how bad it might seem or all the headlines that we've been getting, we are just still sitting in December's price. And behind that, we're still sitting in October's range. We got nothing here, right? We've got some worry, a little bit of risk, but at the end of the day, we're not crashing and burning. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. We've already run up and hit it, so we don't have an MDP, and we're now above it, so we've already broken through any sort of structure that might have been trying to hold us back. Now we're trying to negotiate the upper edge of the channel. This floor pivot is the purple line. The channel around it is what they call the central pivot range, CPR. So if you're looking on whatever broker you're using and you're trying to find a floor pivot that has these channels around it, you could try to search for something like a central pivot range, a CPR floor pivot. Otherwise, you can just turn on the SNR lines, and that's pretty standard for most brokers. There's the R line resistance 1, 68.87, and we got S1 down here, 67.37. It's very likely that those SNR lines today are going to act like the ADR lines today and just keep us within our boundaries, right? There's no reason for us to get some big, massive, ripping move today. It's more likely that we just hold the line and go into the close with a whimper. But we have seen in the past where we'll have, like a pretty squishy week, kind of soft. And this would certainly fit that. It's been soft, even though all these wicks earlier in the week showed our efforts to rally back up. So we could get a really nice reversal today. Just one of those face rippers where we run all the way to 7,000 by the end of the day. I'm not expecting it. There's nothing on the table at this point that says we're going to get it, but we've had it happen in the past, and it kind of lines up with my old TRB style play, right? You got a cup pattern and you have your V patterns, and those can take multiple candles to finally resolve itself and get back up there. What makes TRB so unique is that a lot of times the move back up to the previous level can happen in a single bar. Lots of push. Now, the best of those TRBs would generally happen when the downside had a lot of smaller candles so that we can breach each one of those candles on the way back up. And if we look at the move that we had here, we didn't have a lot of those small candles. So if we're going to get that TRB today, we have to get through this biggest bar, this one from yesterday. Then we can start triggering into these two, this one here and this one here. Those will be the levels that we would really want to get into, because that liquidity from there could give us the fuel to get to that next level, and then that one could get us up through 7,000 and maybe into that 750. Again, there's nothing on the table to suggest we're going to get that push today. And we've already had a really nice reversal so far. We're just looking to see, hey, can we carry that through the rest of the day? Why not, right? So it was a nice start. My concern is that we had this sort of a flat top rising wedge last night, and this could be a blow off top for that, and we could cut down through the whole thing and get below 6,700 today. So you've got both sides, right? If we get the face ripper TRB style setup, we can get back to 7,000 by the end of today. And if we break that 6,750, we could get to 6,600 today. Funny enough, my base case argument is we just stay in the boundary and we don't do much of anything and we just go quietly into the close. So we'll see how it all pans out. Remember, it's all about levels and it won't matter, right? Leave your bias out of it. If we break a level, then it opens the door to the next level and we just keep running it until it stops. It's the way to play it. That way you're not guessing or assuming, just letting it work itself out. As you can see, we got a market maker move this morning. That means they are running additional hedges. Now they're always hedged. These are additional hedges, and it is pure cost for them. Literally just lighting money on fire and watching it burn. They don't get it back again, right? When you buy car insurance or house insurance, you don't get your money back. And if your car gets destroyed or your house burns down, the insurance doesn't even make you whole again. It just helps you recover some of the loss. So when they put on a hedge, they're signaling and indicating that there's so much risk out there at this point that they're willing to buy extra protection, and if it isn't needed, that they'll look at the loss and say it was worth it. So if they're concerned over the possibility of the moves that we could get today, we need to be concerned about the possibility of the moves we could get today. Generally speaking, they won't run a market maker move in the morning if the threat is an afternoon risk. So this very likely isn't because of the executive orders this afternoon. They would have waited later in the morning to start that, right? So if you haven't heard me talk about this before, how do we know that they're hedging just because of this? When Thinkorswim was being developed, Tom Sosnoff's crew, they made this up. This is called a market maker move, right? So most platforms don't have this. In fact, I've never seen any other platform have this because it's proprietary to Thinkorswim. And the creators, the team that built this, literally made it up, right? Now, the idea behind it, if you go to Google and you search market maker move, you'll find Schwab's articles that they've wrote about what the market maker move is. And I think they've got 2, maybe 3. When TD Ameritrade owned Thinkorswim, they had over 20 articles that talked about what this is. That's why I know so much about it, is because back in the day, there was just a lot more articles about it. So what is it? It's looking at the front end, the options that are going to expire today, and the implied volatility average here on the side. And it's comparing that to the next expiration out. We're on the wrong one, so I have to change that in a second. But it's looking at the next expiration out, and it's asking if the front end is higher than the next number out. If it is, then that is an indication that they are hedging. All the articles that I have ever found about this focus on earnings and binary events like M&A deals or new drug trials for different companies, things like that. But what it's highlighting is that the implied volatility average in the front end is greater than the next one out, and that's where we get that market maker move from. To figure all that out, you got to kind of understand what is making this number move. Well, it's a little proprietary. Each broker has its own formula to determine what the average implied volatility is for each expiration. For Thinkorswim, we know some of the data, right? So some of the data is that it uses all of the out-of-the-money options on the put side and all of the out-of-the-money options on the call side, and it's looking at the implied volatility for each strike, and it develops an average of all of that out-of-the-money implied volatility. Then it looks at the square root of time, does some other bit of math that they won't tell us because that's the proprietary secret part, and then we get this number here. So if big funds and firms and institutions come in and they trade very heavy in the overnight in these out-of-the-money options, that will increase the implied volatility average. And if they're hammering the front end harder and faster than they're hitting farther out on the curve, then we end up with the front end with a higher implied vol. If you don't speak geek and you're not into options, I get it. All you have to worry about is that the number on the front end is greater than the next number out. Now, sometimes it's false, right? Like OPEX or new contract change, triple witching kind of stuff. Otherwise, it's a really useful indication that there is a lot of trading happening in the out-of-the-money options. Options implied volatility, just like price itself, will change based on how fast something is being traded, how big the trades are when they come through. So the pace of the tape, the aggression on the trades, are they hitting at the ask and above, at the bid and below? Are they repeatedly hitting it again and again and again? Right? All of those things affect the implied volatility of each strike, and then it gets averaged and normalized and it ends up there. So I'm not guessing or assuming, I'm not giving you my opinion that I think they're hedging. I'm just telling you they're hedging. We can keep our eye on that market maker move throughout the day, and when it starts to drop off, then we know whatever they were worried about is past, because they'll start to unwind it. It also only lives today because it's using options that are going to expire today. So this market maker move can't last through the weekend. It can't last multiple days. It will be done by the end of the day, no matter what, because it won't be alive after the close. So we just want to keep our eye on that market maker move and see if it decreases. If you don't have Thinkorswim, it doesn't matter. You can still see it. All you need is an options chain. Tradeabate's got an options chain, Ninja Trader, right? So just go in and look at the options chain and make sure you're in the front end. Compare the 0-day to the 3-day and see if you've got one number greater than the other. That's how you can spot if there's a market maker move. And be sure to read the articles from Schwab. They help, right? So they're worried, and that worry tells us that my 7,000 target or my 6,600 target is not out of line. We could get a really big move today. The thing is, the market maker move doesn't tell us we're going to make big moves today, just that there's a big enough threat to the market that they're worried and they're hedging. And that tells me if they're worried, somebody's off sides. Some of the biggest moves in the market happens from a market getting surprised, because if they know it's coming, they can hedge to the eyeballs and then they don't have to sell. All right? If they're heavy short, they hedge and they don't have to worry if the market goes up. If they're heavy long, they hedge and they don't have to worry if the market goes down. So they won't run out there and sell like crazy or buy like crazy if the market starts to move. They don't need to. That's what the hedge is for. It's when they don't know it's coming, it's when they get caught by surprise that we get the biggest moves in the market. Somebody knows there's a threat and they hedged. But all parties aren't hedged, or there would be a bigger number. So somebody's offside somewhere. And if that surprise data moves the market, catches everybody on the wrong side, we can get a big move today. But it's all a big if. So I'm not saying we're going to make big moves. We have reached one edge of the ADR early enough in the day, and that means we can go to the other side by the end of the day. We've already been up here. That means we can go down here. That is not bearish. Yeah, it's lower than where we're at. Yes, that does mean I'm talking about us going down, but that's not bearish. That's just price in a wave, right? It's just what price does. So going to the lower edge of the ADR today would just be a function of the wave that price makes, right? This is a bigger version of the wave that I just pointed out here. It's just what price does. The thing about getting to one edge early enough in the day is that sometimes we don't turn around and go to the other side. We keep on the same side and we just keep on going. So one of the things that you can do is evaluate the distance. If we get the breakout at a level, add 2 levels. $69.20 and $69.65. This box is the entire ADR. It's this number up here. 90 points, basically. 45 one way, 45 the other way. So this box is 45. This box is 90. It's just taking the ADR and setting it on one side, right? So if we overshoot the yellow line and we just keep on going, then 69.20 and whatever that other number was, 69.70, those will be the targets on the way back up. And those line up really well when we look left at pivots that we left behind on our trip to the downside. The good thing is this is a really nice setup this morning. One, we've had really good price action, right? I mean, this is really nice. You got to take it when you can get it. But two, it's also just a really good gift. Because if we cut below that red line, we already know where we're headed. We can, of course, mark our half, right? The 50%. So cut that, aim for the 50%, get below that, aim for the Globex low and or the red line down here. It really is that simple. And along the way, you've got the 92 cog, the roundy at 6,800. There's 6811 cog line down here, which is really like this halfback. So we've got a nice gift. All we got to do is begin to break down. Yeah, that was pretty close. 6811 cog line is the halfback. Can't ask for it any better than that. And yet, if we continue to the upside, then we can just look left. We've got yesterday's RTH, and then we've got all of yesterday's high, which will get us into Wednesday's mid and Wednesday's high, and then we can focus on Tuesday's mid and Tuesday's high. And then we're up through the top, and we're looking at 70.50. But I would focus on 7,000 first, and maybe that 70.11 cog line. I think 70.50 is a little too far off, right? Just a wee too much. On the other side of it all, if we do break down, then like I said, 6,600, easy. We could do that, no problem. You like it? I like it. So we've been watching this line here for a while. And we finally took that out. So yesterday we went through that level. We're back up through the other side. Put this on a lower time frame here for a moment. Last night, so where we cut through there. So it did happen in the overnight. I'm going to leave it on here through the day today just to see if we happen to go back down there and interact with it. But next week, we'll take it off the table. We'll be done with it. We had some structure test back here in December where we messed with that level. And it's very likely that even back here, we took everything off the table and kind of made it obsolete. Plus, there is the argument that this is from the last contract, right? So there's a really good argument that, hey, there was nothing here anyways because those contracts are gone. It's not like stock, right? If that was a big stock level, then it would still matter because stock don't have a time frame. But for the futures, the contracts that were traded that make that high volume profile and that point of control, well, they're gone. They expired. We're in a whole new contract series, which kind of begs the question, what the hell did we hit down here if it wasn't those? Something to think about, right? Me, I carry them forward. I don't let the date really interfere with the logic because it's just, it's a process. But there is a good argument to be made that once the contract has changed and you're in the new rollover, that you wouldn't use any of those previous levels. It's not right or wrong. It's just, you need to pick one and stick with it. To the upside, if we're going to get that 7,000 level, we got a lot of work to do. One, we're going to have to get through this week's point of control at 6911 cog line. And then we've got this level up here right around that 7,000. So once we get through the worst of this zone, which is going to be hard to get through, then it gets shallow and we'll be able to move through this area faster. But that's only after we get through this zone, and that's going to be really hard to get through. This is a bit of that TRB setup, kind of that scoop or V style recovery. So the thing that we're looking for is a solid shot all the way back up. We don't want to see this take 2, 3, 4 days because that would just be a regular cup or more of like a U shape or a V pattern and not a TRB. Ten-day, 30-minute volume profile in TPO. It's certainly a cleaner profile now than it was late last week and even early this week. The TPO looks really good, classic, but the volume profile is a lot more messy. We're lined up on the point of control. The value area on the TPO is just a little bit bigger. Everything is up across this top, and if we're going to get into that 7,000 level, you can see everything that's in our way. There's a lot of trouble we're going to have to work through to get back up there. So we would need significant headlines, right? We're going to need something serious push, some macro trigger that can fire up this market and get everybody aggressively strong to the upside. I have no idea what the heck could cause that. Not today, right? But it doesn't have to be something from the economic calendar. It can be some gotcha headline, right? So just be ready for it, right? My base case is that we get no run, that we stay range bound into the end of the day and we just go quietly into the close. But if we do get that breakout up or down, I don't care. Whatever direction we go, I'm going to play it, right? So what do they say? Plan for the hope for the best, plan for the worst. Well, there you go, right? My base case is we're just going to go sideways into the close, but I will have a plan for a big breakout run. Not a lot of insight for yesterday's levels, other than it could be considered a lowercase b classic profile. It's not really all that good of an example, but that's about as good as we've got. This morning we've got two different distributions, really thin area through the middle here. So if we do break back below that 68.42 old school cog line, we could dip through the shallow area quickly and get back into 68.11. That would get us into this lower point of control this morning, and then we'd have all this trash down here to work with. There's not a lot of insight or opportunity on this time frame. Nothing really stands out. They're putting in a lot of work across this high. It's not thin and shallow. That's about all we can say from this level, right? It's about all we got. So we got to keep our eye on it and see if the work that they're putting in is going to be enough to hold us down, or if we're going to be able to push through that anyways and keep on going. We got this area up here. You can see this high volume node. Compared to all this, it doesn't seem like it's a very high volume node at all, but it is a bit of a bump right above 6,900. So it shallows out, right? Gets real thin here before it starts to bulge again. So if we can get through our own Globex high, we get into that shallow area, and we can generally move through shallow areas relatively fast, down or up, right? See how quickly we moved through that level before. We didn't leave much of a footprint behind. It is Friday. Dun, 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 dun. So we have next week's range projection. It's not set in stone yet. This range is going to change through the day today. But after the close this afternoon, it'll lock, just like all of these old levels are locked, and then it won't move anymore. Right now, it's still alive, it's still moving. What I like to do on Fridays is measure the projection and compare it to my current week. I like to do that on Fridays because, I mean, the current week is still fresh in my mind. I've been here, right, all day, every day. So if I did it on Monday, then I had the weekend. We forget stuff, and by Monday, I might forget what I had for dinner on Friday. But if I do this on Fridays, I've got a better memory for what happened this week. Well, this week's range is narrower than next week's range. So they're pricing in more volatility. We can see that just because the width is larger. The width of this range is derived by two pieces of information. One is volatility and the other is time. Our current week was a 5-day week. Next week is a 5-day week, so time is the same. That means the only thing that changed is that we have more volatility next week, and that's why the range is bigger. At first glance, you might think, oh, well, next week must have some big economic event. That's why it's a bigger range. The thing is, economic events are volatility suppressing. So if next week was CPI, PPI, non-farm payrolls, FOMC, those are all volatility suppressing events. We'd have a narrower range. And then we would be looking for what I like to call a hurry up and wait scenario. That's not what we're looking at. It's a broader range, and it's likely not connected to the economic calendar. It's not OPEX, because OPEX is the third Friday of the month. That would put us at the 20th. So it's not that. But they are pricing in greater volatility for next week. Volatility is another word for movement. So they're expecting big moves or this continued large candle next week, just like we've gotten this week. This week was just a bunch of big, large candles. And they're saying, if you liked it, good, because you're getting more next week. We're still below the 10-week. This really doesn't seem like it's changed all that much from yesterday. Just remember that we can swap from being underneath to being above by 1, 2, or even 3% in a day, right? We've got plenty of examples where we were down 1.5, and by the next day we were up 1 or up 1.5, 2. So we can get radical changes from one direction to the next. And a lot of times getting down here below the zero is just a bit of a pullback before the next spring up. I've still got my eye on a breakout above, say, 2.25 or 2.5, so that we could end this lower high, lower high, lower high situation, but we don't have one yet. All right, and on the daily, it wasn't a one and done like one of these where we just dropped down and got back up again. We've actually sustained ourselves down here, but it does look like we're on the mend, right? There's plenty of examples where we set the low and then we, set a higher low and then crossed the line. Well, we set the low just like here. And so far right now, we've got a higher low. So we could get back up here today even, or even into next week, right? We are less than 1% above, below the 10-day. So we're around that 1%. That means we're not on the zero line. We need to get to the zero line first, get through it, and then focus on getting at least 0.5% or 1% above the 10-day. But the first step is just to get back to the 10-day. That's step one. So if we do get that push today and we break our own Globex high and we start making that run to the upside, keep your eye on the 10-day. Where it is matters, right? $69.16. That's the 10-day right there. There's the 10-week. There's the 10-day. All right, looking at what's down in the overnight, we got the VIX down 7%. It's still up 23% over a 5-day period. And that means it was up over 30% in a 5-day period. So just because we're down 7% this morning doesn't really give me that warm, fuzzy feeling. The Mag 7 down volume is down 1%, but that was up almost 22% in a 5-day period. And then the Mags is down this morning 0.5%, which now makes it down 5% in a 5-day period. Looking at what's up, Bitcoin, more Bitcoin, uranium, gold miners, chips, expanded tech, metals and mining, uranium, generic tech, Mag 7 up volume, which is a little weird. Mags is down, but the Mag 7 up volume is up. China is also up, or at least the China ADRs for the internet ETFs, this KWeb group. Emerging markets, that's basically China again. Bots, growth, finance, quantum, banks, cloud. When it comes to getting a rally day, those risk on sectors that we really need, they're the ones we want to focus on, keep our eye on. Generally, focus on it like this. The top three are the risk-on markets. The bottom three are the risk-off markets, and the three in the middle are kind of the midline. They can do well in either sort of a market environment. But when we look at it this way, and we've got the top three here, finance, XLF, that's really generic. I like to tighten that up and use something like KRE, the banks. Generic tech, it's just so generic. It's so vague and broad. You can use a lot of things in the place of that, right? Cloud computing, chips, semiconductors. There's just so many things that you can get more specific on when it comes to tech. And then the consumer discretionary. If we're going to have one of those rip your face off sort of rally days, we need two of these sectors at least. Consumer discretionary and finance, or tech and finance, or, tech and consumer discretionary. Got to have at least two. And we've got all three this morning. So we have the conditions for a really amazing rally day today. It still doesn't mean we're going to get one. Just that when I'm looking around trying to check the box on whether or not we could get a rally day, one of the things that I like to check is, do we have the right sectors for a rising tide scenario to lift all boats from market breadth? Check. We do. Yes. This is the NASDAQ 100. I'm running a scan that asks how many stocks are up that are in the NASDAQ 100 at least 0.5%. I like to use 100 because the number can be normalized into a percent. So it says 60 stocks are up at least 0.5%. We get to rephrase that. 60% of the NASDAQ 100 is up at least 0.5%. That's bullish. It's not wildly, excessively bullish. It's bullish. I've run this multiple times this week. Earlier this week, we seen 12, 20. We got 60 today. That's a really good check mark for, do we have broad market breadth that could cause a breakout rally day? Yeah, we do. Now, just because we have 60 names, they're not all equal, right? I don't really care if Caterpillar's up today, because Caterpillar's not going to give us a breakout rally day. But semiconductors could, and we have a lot of those. Also, just having the Mag 7 itself, that group, that could certainly do it. So, when you look down the line and you see Shopify, Tesla, PayPal, all the semiconductors in there, and then a lot of the AI plays like Seagate, the memory chips, and Western Digital. We got a lot of the names that we need, right? Now, of course, one problem we would have is if they got too extended in the pre-market. That would be a problem, because once we got it into the open, they wouldn't have any reason to continue to run. They'd already did all of that running in the pre-market. So we want to keep our eye on it, make sure they don't get, quote, too extended in the pre-market. Unfortunately, there's no way to do that in a collective package. We would have to do it each individually, kind of checking their Z-scores or whatever. The market gap looks decent, right? I see a 2% in here, but a lot of these are just 0.5%, or a little higher than a half. It's fine. So that's the NASDAQ. Check the S&P. Oh, that's the negative. We don't want the negative. 45% of the S&P 100 is up at least 0.5%. Yeah, it's not 60, but it's still a really good number. So again, we've got the market breadth for a rally day today. I would still want to see a follow through, right? Some help from dollar, bonds, commodities, something, so that it doesn't have to be just the broader market breadth. Even some 0-day flows in the SPY QQQ, that could really help us out, right? So we have the conditions for a breakout rally day. That can all unwind really fast, by the way, so don't get too hung up on the bias that says, yes, we're definitely going up. If it breaks, then you got to be prepared to take the other side. All right, we went long enough, right? I kind of hammered the point, I think, by now. GTFO, you got to get out of the box right now. Box is yesterday's price. So we've got our Globex low. We've got yesterday's price on the RTH. And then we've got yesterday's price all of yesterday. You can see the overlap. So get new highs on the Globex, target those levels I gave earlier, continue to run it to the upside. Otherwise, if we flip, then take the mid. Get through the ADR low, take the mid. Yesterday's low, then our Globex low, and run it to the downside. Simple, simple, right? It's a really nice gift this morning. I got to say, couldn't ask for something any better on a Friday. With that, everybody, be careful, be safe, have a good weekend. Watch the clock, and I'll see you all Monday.